Okay, so welcome to the deep dive, where we take a look at the stuff you actually care about. No doom scrolling, no endless news feeds, just pure signal.
Pure signal, straight to the point.
Exactly. And today we're going deep on market commentary from Tom Lee of Fundstrat. You sent us his recent CNBC interview, and we're going to pull out the most important bits, break it down, make it make sense.
Distill it down into those nuggets of wisdom that you're looking for to make sense of this crazy market we're in.
Yeah, I mean, the big question on everybody's mind, are we at the bottom? Have we hit it? Tom Lee actually seems to think so, potentially even this week, which is a pretty bold call given the recent market action. I
Yeah.
mean, the S&P 500 just dipped into correction territory, full 10% down from its recent peak.
And that was after already being down about 6%. So, it has been a wild ride. Volatility is definitely back on the menu.
It definitely is. So what's Lee seeing that maybe the rest of us are missing? What's driving his optimism here?
Well, despite the doom and gloom and those weekend futures that looked pretty scary, Lee's analysis points to a market that's actually pretty oversold. He believes that a lot of the de-risking has already happened. Investors have already pulled back, so there might not be as much selling pressure left as some people fear.
Okay, so maybe the pain is already mostly priced in, but what was all that fear about in the first place? Like, what spooked everybody going into April?
According to Lee, there's a few big things weighing on investors' minds. First off, you've got the whole tariff situation, this big unknown of how extensive they might be, what sectors they'll hit, and what the ripple effects will be for the economy.
Right, that's that whole trade war thing that's been brewing.
Exactly. And then you've got this general anxiety around White House policies, the kind of unpredictability factor. And then on top of all that, you've got this overarching uncertainty about the overall direction of the economy and where things are headed.
Yeah, classic fear, uncertainty, and doubt.
Exactly. But Lee seems to think some of that fog might be lifting soon. He specifically mentions the period after Wednesday as potentially significant. Like, we
Yeah.
might get some more visibility on these key issues, and that could ease some of the selling pressure.
Okay, so less uncertainty, more clarity. Maybe that brings some buyers back in. Makes sense.
Right. I mean, think about it. If you're an investor and you have no idea what's coming next, you're probably going to sit on the sidelines. But once you have a clearer picture, you might be more willing to jump back in.
Interesting. Now, Lee also brings up this really interesting comparison to Brexit. He points out that despite all the initial doom and gloom, the UK economy and its stock market actually held up reasonably well. He uses this example to kind of push back against those more extreme predictions of the US economy completely falling apart.
Yeah, that's a compelling analogy. Both Brexit and the current situation involve a lot of uncertainty and potential for disruption. However, the scale and interconnectedness of the U.S. economy, particularly with the global markets, might make the tariff situation fundamentally different.
Right. We're not just talking about one country leaving a trading bloc. This is
Yeah.
potentially reshaping global trade patterns.
Exactly. And, the nature of the economic shock itself is different. Brexit was primarily a political decision with economic consequences, while these tariff discussions are directly about trade and economic policy.
Okay. So different beasts, but maybe there are some lessons to be learned from how things played out with Brexit. Now, one of the big concerns we've been hearing lately isn't so much about a complete collapse, but more about this possibility of stagflation, slow growth and persistent inflation. Not a great combo.
No, not at all. And it's a tricky situation to navigate, because the usual tools that governments and central banks use to fix one problem often make the other one worse. It's a
Yeah.
tough balancing act.
Yeah, I mean, if you try to stimulate growth to combat a slowdown, you risk making inflation even worse. And if you try to clamp down on inflation too hard, you risk choking off growth altogether. It's a tough spot to be in. Now, Lee has this really interesting idea about how these tariffs might be creating some distortions in the economic data we're seeing.
Oh, yeah, that was fascinating. He talked about how the anticipation of tariffs could actually be leading to a pull forward of demand in certain areas, like, cars, wine, anything that people think might get hit with higher prices later on.
Right, so you rush out to buy a car now before the tariffs hit and the price goes up.
Precisely. But that creates this artificial spike in demand that doesn't really reflect underlying economic strength. And it could actually lead to a slump in sales later on once the tariffs are in place and everyone who was going to buy a car has already bought one.
Ah, so those rosy economic numbers we might be seeing now, maybe they're not telling the whole story.
Right. They could be giving us a false sense of security, or at least not the full picture. And then on the inflation side, Lee suggests that maybe, just maybe, The inflation we're seeing isn't as deeply entrenched as some people fear.
Oh, really? So maybe it's not all doom and gloom on the inflation front either. I like where this is going.
Yeah, well, his argument is that economists might be too focused on the negatives of tariffs and overlooking some of the potential positives. He mentions things like lower interest rates and potentially lower gasoline prices. Those things could actually help support economic activity and offset some of those inflationary pressures. So, what we're calling persistent inflation might actually be a reflection of these temporary distortions rather than a sign of a long-term stagflationary environment.
Okay, so maybe we need to take a deep breath and not jump to conclusions. There might be more to the story than meets the eye. Now, let's talk about inflation and the Fed. Earlier in the year, Tom Lee was pretty optimistic, partly because he thought inflation wouldn't be this sticky, but the latest data seems to be telling a slightly different story.
Yeah, some of those inflation indicators haven't come down as quickly as many had hoped. And even Goldman Sachs recently raised their forecast for PCE inflation, which is a key measure the Fed watches very closely.
Right, and higher PCE inflation usually means less room for the Fed to cut rates, right?
Right.
Because they're trying to keep inflation under control.
Exactly. Higher inflation means the Fed has to be more cautious about lowering rates because that could potentially fuel even more inflation. But here's where it gets interesting. Even with their higher inflation forecast, Goldman Sachs is still predicting rate cuts.
Okay, that's a head scratcher. Why would they predict rate cuts if they're concerned about inflation?
Well, it all comes down to economic growth. The thinking is that while inflation might be sticky, the risk of a significant economic slowdown will eventually outweigh those inflation concerns. And that'll force the Fed to lower rates to stimulate the economy, even if it means inflation stays a bit higher for a while.
So they're betting on a slowing economy.
Mm.
That's not exactly good news.
Not necessarily. It really depends on the severity of the slowdown and how the Fed manages it. But Lee seems to be in the camp that expects a more dovish Fed, meaning they'll be more willing to cut rates than the market is currently anticipating.
Yeah, he even pointed to Fed Chair Powell's upcoming speech after the jobs report as a potential signal of that more accommodative stance.
Yeah.
Like, keep an ear out for any hints that the Fed might be shifting gears.
Exactly. He even referenced the market's reaction after the March FOMC meeting, suggesting that there was an underlying message of dovishness that maybe some investors missed. So this upcoming speech could be an opportunity for the Fed to clarify its position and potentially calm some nerves.
Okay, so we've got tariffs, inflation, and a potentially dovish Fed. Lots to think about there. Let's switch gears for a minute and talk about crypto. Bitcoin's been testing some lows recently, which seems to be tracking with the overall risk-off sentiment we've been discussing. It's like Bitcoin and the NASDAQ are joined at the hip these days.
Yeah, that correlation is definitely something to watch. Bitcoin tends to behave like a risk asset, particularly in sync with tech stocks. So when there's fear in the market, both Bitcoin and the NASDAQ tend to take a hit.
But Lee sees potential for Bitcoin to really take off if the Fed does pivot to a more dovish stance or even starts cutting rates, especially with QT, quantitative tightening, coming to an end. Just a reminder for our listeners, QT is when the Fed reduces the amount of money in the system, which tends to put downward pressure on asset prices.
Right. So if the Fed stops tightening and starts easing, that could create a much more favorable environment for risk assets, including crypto. Lower rates, more liquidity, that all tends to be good for things like Bitcoin.
And Lee's long-term target for Bitcoin is still pretty ambitious. He's still talking about $150,000 or even higher once we get past this tariff uncertainty. That's a heck of a lot higher than where it's trading now.
It is a bold prediction, but it shows his conviction in Bitcoin's long-term potential. He seems to think that these current headwinds are temporary and that once those clear up, Bitcoin has a lot of room to run.
And the wild thing is, he hasn't even looked at the recent price action. He just believes in the fundamentals.
Yeah, he's looking at the bigger picture.
Now, what about the U.S. dollar? There's been some talk about it potentially weakening as a result of certain policies. And Lee seems to agree with that idea. Why might that be?
The thinking is that certain government policies, particularly those related to trade and spending, could put downward pressure on the dollar over time. A weaker dollar can have both pros and cons. It can make U.S. exports more competitive, but it can also lead to higher import prices, which could contribute to inflation.
Right, so a balancing act there. And in the context of crypto, Lee brings up the importance of stablecoin legislation. How does that fit in with the future of the dollar?
This is where it gets really interesting. Stablecoins are cryptocurrencies that are pegged to a more stable asset, usually the US dollar. Lee's argument is that clear and supportive regulations for stablecoins could actually help maintain the dollar's dominance within the crypto world. So, even if the dollar weakens somewhat in traditional markets, it could remain a key player in the digital asset space, especially if there's a solid framework for dollar-backed stablecoins.
So kind of like a digital dollar for the digital age.
Exactly. And finally, we have to talk about sourcing coin. You know, the one Lee mentioned adding to his crypto portfolio? He seemed really positive about it, even without knowing its recent price action.
Yeah, that was pretty intriguing.
Yeah, he used phrases like building a base and strong reputation. The chart looks like a coiled spring. Those are all things a technical analyst might look for, like a period of consolidation that suggests accumulation, a solid project team, and a chart pattern that hints at a potential upward move.
Okay, so maybe not just a random pick. There's some method to the madness.
Yeah.
All right, so let's bring it all home. What are the key takeaways here? Lee seems to be suggesting that a market bottom might be near if we can just get past this cloud of uncertainty hanging over everything.
Yes, and he's pointing to Brexit as a potential model for how things might play out. That even in the face of significant uncertainty, markets can be surprisingly resilient.
And while he acknowledges the inflation concerns, he's also highlighting some potential distortions in the data and the possibility of a more dovish Fed than many expect. That dovish stance could be good news for both stocks and crypto, which helps explain his continued bullishness on Bitcoin and his intriguing interest in sourcing coin. And finally, he's on board with the idea of a potentially weakening dollar, but he also stresses the importance of stablecoin regulation in preserving the dollar's role in the crypto world.
That's a great summary. He's definitely presenting a nuanced view that acknowledges the risks but also sees potential opportunities.
So for our listener who wanted to get a clear and concise understanding of Tom Lee's latest thinking, hopefully this deep dive has done just that. We've broken down his key arguments, explored the context, and tried to cut through the noise.
And now, we'd like to leave you with something to think about. Given everything we've discussed, what specific economic indicators or market signals will you be watching most closely to get a sense of where things are headed? Will it be inflation data, the Fed's next move, or something else entirely? How will you use that information to navigate these uncertain times? We'd love to hear your thoughts.
Until next time, happy investing, everyone.
Happy investing.